Which economic indicators guide central bank interest rate decisions? Imagine trying to steer a ship through unpredictable waters. Central banks do just that, using key economic indicators as their navigational tools. They look at many signs from the economy to decide whether to raise, lower, or keep interest rates steady. These decisions aim to balance growth and inflation, making sure the economy stays healthy. One of the most important signals is inflation. Central banks track how fast prices for goods and services are rising. They use measures like the Consumer Price Index and the Personal Consumption Expenditures Price Index. If inflation is higher than their target, they might increase interest rates to slow down price rises. If inflation is too low, they may lower rates to encourage people to spend and invest more. Employment data is another key factor. Indicators like the unemployment rate, how many jobs are being created, and wages tell central banks how strong the job market is. When employment is growing and wages are rising, it suggests a healthy economy but also potential inflation. If job numbers are weak, central banks might lower interest rates to help create more jobs and boost economic activity. Gross domestic product growth rates give a broad picture of how the economy is doing. If GDP is growing quickly, it might signal overheating, leading to higher inflation. In that case, central banks could raise interest rates. If GDP growth slows or turns negative, they might lower rates to stimulate demand and support economic activity. Consumer spending and business investment are also closely watched. Retail sales and orders for durable goods show how much consumers are buying. Business investment, like capital spending and manufacturing output, reveals how confident companies are about the future. Strong numbers can lead to rate hikes, while weak data might prompt rate cuts. Financial market conditions matter too. Stock prices, bond yields, and credit spreads reflected investor expectations about the economy. Rising bond yields might suggest higher inflation expectations, prompting central banks to consider raising rates. Falling stock prices could signal economic worries, leading to lower interest rates to support growth. Wage and price expectations are surveyed or measured through market data. If people expect higher inflation, central banks may raise interest rates preemptively. If expectations are low, they might keep rates steady or lower them to boost spending. External factors like global economic trends, exchange rates, commodity prices, and geopolitical risks also influence decisions. Sharp changes abroad can impact domestic inflation and growth, prompting central banks to adjust interest rates accordingly. All these indicators help central banks decide the best course of action. Raising interest rates makes borrowing more expensive, slowing down spending and inflation. Lowering rates makes borrowing cheaper, encouraging more spending and investment. They use this data to set the tone of monetary policy, whether it should support growth or control inflation. This data-driven approach helps keep the economy stable and growing over time.